Hello and welcome to the Expat Tax Thailand Double Taxation Agreement webinar. I'm Carl Turner. I'm delighted today to be joined by Alina Kulikovska. She is, I hope I said that right, Alina?
Yes, perfectly fine.
Great.
Thank you very much. Good evening to everyone.
Yeah, great. So she's an accomplished international lawyer specializing in corporate and tax law, and she's an expert in double taxation agreements between different jurisdictions worldwide. So Alina works with both corporate and personal tax planning globally and is based in Cyprus.
Thank you very much.
Okay, so if you've got any questions, there are multiple ways you can get in touch. Feel free to ask questions on the Q&A, or you could send an email to info@Expat Tax Thailand or Carl@Expat Tax Thailand, or through our website. The Thai Revenue Department, they've actually put out a lot of information now on the new rule changes. There's a lot of guidance notes and videos that explain this, and it's our job at Expat Tax Thailand to really get this information to individuals so that they can make better informed decisions with their own personal taxation. So just to let you know, this webinar is being recorded, so we'll send out the recording after by email, and we'll also provide answers to any questions that have come in by email as well. So just a quick disclaimer, the content provided is intended for information purposes only. It doesn't constitute professional tax advice, and it should not be acted upon just from the webinar itself. So onto the webinar content, the areas that we discussed today, there are 11 main areas. So we'll discuss the purpose of a DTA, a double taxation agreement. We'll give an example and explain the local Thai income tax rules. We'll also explain some common misconceptions from individuals, what a DTA actually is and what it does. And then we'll explain what a tax credit is. We'll give a really good case study and a practical example, and then close with a Q&A and tips. I'd like to mention about our survey, which will be emailed out. I'll put it in the chat now. This is basically so that you can actually advise us anything that you would like us to do further research on and send out to you specifically. So any specific DTA or any asset that you would like advice on, if you send it through the survey, we'll put together the content, and the most popular ones we'll do first. And we aim to get back to everyone that submits to us. So let me put that in the chat now. Let's have a look how I do that. Second, okay. Right, I found out how to do it to everyone. Here we go. So there we go. That's the link for the webinar survey. So feel free to fill it out either now or afterwards. But that's what we'll go through. So Alina, welcome again. Can you explain to us, in simple terms for ourselves, what's the purpose of a double taxation agreement for personal income tax, and what does it actually mean? What does having a DTA in place actually mean, and what's the purpose of it?
First of all, Carl, thank you very much for inviting me for this very interesting and very important webinar. And I really hope that all the information that will be discussed today that will help people, help all the attendees. And when we're talking about double tax treaties, we are talking even from the understanding, double tax treaty. It means like that some tax will be taxed twice, double. So we, in the world, countries, they received, like they faced a lot of situations where, especially with the globalization and all this kind of processes where the individual, they have rights to have business all over the world in the different countries. They're keen to receive dividends or interest, some personal incomes from all those different jurisdictions, and same from the jurisdiction where they are tax residents or where they are citizens currently. So the main purpose of double tax treaty is, first of all, to avoid double taxation, to avoid to be taxed twice for one income that you are receiving from one source. So we're not talking like in general, if you are receiving dividends, so we're not going to be taxed twice, because some part of dividends can be sent from the country or the company where the that is tax resident of the country that has double tax treaty, and another part can be sent from the company that has no double tax treaty with, in our case, Thailand, when we're talking. So basically the main purpose is to help those individuals who are getting their personal income, and first of all, personal income, either passive income or active income from the activity, from the business activity outside of Thailand, or from the immovable property as a passive income, dividends, interest, etc., not to be twice. But we need to understand that there are a lot of conditions how we can get those double tax treaty work. So there are a lot of points that we need to put under consideration when we're using double tax treaty. So we can claim that you may minimize your personal income tax based on the double tax treaty, but no one from the tax experts and no one from the tax planning advisors explains how to do that. And there are a lot of conditions that are written down in, especially in double tax treaties.
Okay, clear. Yeah, thanks for that explanation. So what I thought we'd do is just go through an example DTA. So this is the US-Thai double taxation agreement. So it's 42 pages long, it's 31 different articles, and it really sets out how assets are taxed, and also it explains about personal income tax as well. So within the US-Thai double taxation agreement, what I thought I'd do is just show an example of where a DTA takes precedent over the local domestic tax law. So this shows regarding social security payments. So it explains that social security payments are not taxable in Thailand. They're only taxable in the first mentioned state, so in the US only. So on remittance into Thailand, even though the local Thai domestic rules show that foreign source income, which pension income is taxable, if it's remitted to Thailand, it's taxable, but the DTA shows that it's not taxable. It's not a taxable source in Thailand. They don't have the right to tax it. So what I thought I could do, I'm just explaining it simply, but Alina, if you could just explain, what does this actually mean, this takes precedent? What is it, a DTA taking precedent over local domestic tax law? Yeah, could you just give me a bit more information on this from my simple explanation?
Of course, of course. So basically we have, first of all, we have international law. Yeah, so DTAs is a part of international law. It's a part of relationship between the countries. So in each country, we have the privilege of international law over the domestic law. So basically, when we are having this situation where all the remitted income sent to Thailand should be taxed in Thailand, and all the pension that tax resident of Thailand they are receiving, even if they are from the United States, in our case, it's United States. So in that case, we can use a double tax treaty that may minimize our personal income tax. Because in the legislation of Thailand and in any other legislation, it's written that some particular norms of law that the pension should be taxed, received in Thailand should be taxed in Thailand, if nothing is, if no other is written by any other international legal agreement. So in our case, we have double tax treaty. So double tax treaty has more power over the domestic legislation. So we can use double tax treaty, but it's not so easy to use a double tax treaty. Basically, we need to, first of all, if you are a citizen of the United States, you need to understand that you're going to be a tax resident of the United States for your entire life. So it doesn't matter where you are living. You might live in Thailand, then you might be a tax resident according to the tax legislation in Thailand. Same time, you need to report to the tax authorities in the United States. So this is the main problem. I think this is the main problem, and this is main specific point for all the tax residents from the United States. So they are tax residents of the United States as long as they do have passports of the United States. So so basically, if you want to avoid this paying second time tax in Thailand, in that case, you need to first to declare that you are receiving the social security payments or pension contributions from the United States. You need to, first of all, to submit and report to the tax authorities in the United States. And only after that, once you are receiving a declaration that you have submitted and where will be written how much it was taxed, the amount it was taxed, then you can, and where will be written also the purposes you were taxed for from this particular amount, only in that case you can go to the tax authorities in Thailand and again to declare that amount. So basically it doesn't mean that you're not gonna declare this amount, you are declaring it, but in a declaration it will be written that you have all the proofs that according to the double tax treaty, according to the Article 20, according to the point 2 of Article 20, you were paid tax already in the United States and you are not gonna pay tax in Thailand. If you don't have this confirmation, unfortunately, in that case, you will have to pay tax twice. And this is the main problem, what people, they don't think about.
Yeah, okay. So clear. Thanks for that, Alina. So my understanding is, what I took away from that is, even if there's a double taxation agreement and even if there's an exemption, or you can use a credit, you still need to file in Thailand and declare with the tax confirmation or some sort of tax clearance form to show that the tax has been paid in another jurisdiction.
Exactly. And we're talking here not only about the United States, we're talking about this is how double tax treaty they work in general. So you need to declare twice this amount, this particular amount.
Clear. Yeah, thanks for that. So at Expat Tax Thailand, what we've done is we've done all the hard work for you. On our website, we've researched all the 61 DTAs that are available, and they're available to download on our website. The link will be sent out with the email afterwards. So all of them are on there, all 61, all the way from Armenia, all the way down to United Kingdom at the bottom. So to give people a full understanding of the double taxation agreements and how it actually works, what I thought it would be good is just to take a few steps backwards and explain briefly what the tax rules are in Thailand for personal income tax, especially around foreign sourced income remitted to Thailand. And then once we've got this base knowledge, it's easy to understand how the DTAs and tax credits can potentially be used. Again, we've got all this information on the website, all the official information from the Thai Revenue Department. We'll send a link to you with all the official rules and the notifications that have been sent out, so you can read the facts and information all in one place. So onto the rules. So the new income tax rules, they changed on the 1st of January 2024. It was from an announcement, a departmental order rather than a rule change, a law change in September last year. This related to foreign source income and how it's remitted to Thailand. So this relates to everything from pensions, investment capital gains, property rental income, overseas salaries, dividends, property sales, royalties. There's a long list. So if you remit any of these assets to Thailand while you're a Thai tax resident, so 180 days or more in the country, you're liable for personal income tax in Thailand on this remittance. So this is for all visa holders. It doesn't matter what you hold, whether it's a retirement, spouse, education, work permit. It doesn't matter on this. It all matters to do with the amount of days that you're in Thailand. Now, there's one exemption, which is the LTR visa, which is an exemption on foreign source income, but everything else, it follows the same rules. So what I thought would be good to start with, Alina, is, with your experience and what we see with the questions coming in, there are quite a few misconceptions. You've actually discussed quite a lot of these already. But
Yeah.
you know, we could just explain what are the common misconceptions that people have with these DTAs. I know you've explained this in detail already, actually.
Okay, the main I've started and I already said that people think that if they use the DTA, if they pay tax once, they shouldn't declare this amount because it's already paid. It's already taxed. What the point to declare it? But yeah, you need to declare it second time in a country of your residency where you are getting income if it was paid in a source country. Another point, what people, what I'm facing, especially with Thailand, that majority of the cases, my clients from the United Kingdom or from Australia, they might live and be tax resident of Thailand, but same time they're having business back home or somewhere else where they are also directors and they are managing and controlling those companies. So the problem is that according to the tax legislation, according to the DTAs in Thailand, with Thailand, everywhere it's written that if you are managing and controlling of some entity from the Thailand, is a high chance that this entity will be recognized as a tax resident of Thailand. And first of all, and you will have to pay income tax according to the legislation in Thailand. So is going to be claimed as a permanent establishment, and permanent establishment in that case have to pay tax from the income that is received by this permanent establishment. And here also another challenges for the clients, because in that case they need to go back to that country where the company is located, because it's presumed that company is a tax resident in that other country, in other contracting country. And this is how actually clients, they're getting problems with receiving dividends, sometimes with receiving royalties or interest or whatsoever from the business. So this is what you also need to think about. Another point, when we're talking that the percentage, when we're talking about the percentage, and like standard rate might be, especially for the withholding tax, the standard rate in the United States is 30%. Withholding tax is 30%. And people think that if they're using double tax treaty, they can minimize it to 15% or 20% on dividends or royalties, and same time they will not pay the rest. But in the majority of the cases, the rest will be paid in the country where you are receiving those dividends or royalties. So don't think it depends, obviously depends on the percentage of tax to be paid. So when we are talking about double tax treaty, it's a very simple but same time it's very complicated agreement that helps people to minimize their tax only in some particular conditions that are written in this agreement. And sometimes if you've seen, and yeah, Carl, you've seen that in agreements when you're reading about double tax, about some for instance, about dividends, you can see some links to another articles that also should be taken into the consideration. So when we're talking about dividends or pensions or some social contributions or whatsoever, that's mean that there are additional articles will be used as well. And people sometimes they don't think about that, unfortunately.
Yeah, so it's complex and it's confusing at the best of times, and there's a lot of misconceptions that we see. So through this, hopefully we can answer quite a lot of these. So the next thing is the tax credit. So it'd be really good, you know, we understand the basic rules on double taxation and what it actually means, but really, what is a tax credit, Alina, and how does it work? You know, just give a quick example of what a tax credit is. And you know, how can people actually use this? If, for example, personal income, let's say for pensions, let's say they're taxed in one jurisdiction. Let's say just an example. Let's say they've got a French pension, and the rules a private pension, and the rules state that it can be taxed in France, and then if they're living in Thailand and they're remitted into Thailand, it can be taxed in Thailand as a Thai tax resident. If you could just explain how this credit actually works, you know, in that sort of example for the money that they've actually paid in France, would be great.
So actually we have first of all withholding tax because we have tax in the country that is paying that tax. So basically first we will use the taxation of France. Yes, we will use that tax rate on actually the income, the social contribution and pension that will be sent to Thailand. So we are getting their tax. So those pension will be taxed in France. Same time, by paying tax in France, we're getting a credit. So we're getting information that some percentage, some amount has already been paid.
Right,
So
right.
as we started with the United States, yes. So we are declaring that amount that is already paid, and same time we have that credit. We're declaring that we are having a credit in France. So once we're having a credit, we are receiving money in Thailand, and we need to pay tax on receiving a pension. So because money remitted to Thailand. So we are declaring that amount, explaining that we already have credit and the amount is and tax is already paid in France. So what you need to understand that most probably the percentage can be smaller or bigger. So you will never receive, it's as mentioned on the slide, that credit is non-refundable. So you will not receive refund if it's like you've paid more.
You don't get a rebate if the tax is higher in the jurisdiction that where the asset is based. If the tax rate in Thailand's lower, you're not getting any money back, but it means you don't have to pay any more.
Unfortunately, but same times you will not be taxed in Thailand second time because you are using your credit. And same time, other way around. So if you are paying something in Thailand and you are sending money overseas, so there you are getting here credit in Thailand, and then the tax authority in another country will check whether you are paying something additionally or not. That's why we have a double tax rating. And there are some articles, there are some points that will allow you to minimize this tax. Especially it's not so popular for the pension or social security payments, but it's very popular for when we're talking about dividend, interest, or royalties. There you can see and you can find there actually the percentage that can be used to minimize your tax, so especially withholding tax when we're talking about it.
Yeah, that's good. Yeah, really good. So, the general principles around DTAs, they are as follows, what we've sort of gone through. Really, you need to check each double taxation agreement for the jurisdiction your assets are based. So it's not based on nationality, it's based on where the jurisdiction, where the location is of the assets that are actually paying the income and where they're actually based. Then you need to look at the double taxation agreement to see if there's any exclusions or exemptions or special rules. And then in principle, the majority actually show that if the funds are remitted into Thailand, you can use the tax paid as a credit. Doesn't mean there's no tax, like we explained. That's a general principle. Some actually show special rules, but the majority are like this. Then we use the Thai personal allowances, not the overseas allowances, which also some people get quite confused with. Thailand only focuses on the tax and your personal allowances in Thailand. It's not relevant if you have a personal allowance in Australia or elsewhere. That's not taken into account. All they look at, exactly what Alina mentioned, was the gross amount and your net amount that you received. So how much was your pension or whatever asset it was that's paid out? How much was the amount before tax? How much was the amount after tax? And that difference is the tax that, can be used as a credit as a percentage terms. So what I'd like to do now is go on to really a case study so that we can sort of go through how these DTAs work in principle. And again, mentioned earlier, if you can use that survey to fill out for any DTA that you'd like assessing, and then we can provide content for very specific situations. In this case study, we'll go through the core rules and go through quite a few different situations, but obviously we've got over 300 people on the webinar, so it's very difficult to go through all the DTAs and questions here, but the idea is we'll provide all the information for anyone who gets in touch. We'll research and send out exactly the information for your own situation. So on to the case study. So what we've done is put together an example Thai tax resident. And the purpose is so that we can go through the process of how they would start to calculate their tax and look at some of the complications with their situation. So I'll read out this case study and it will help quite a lot of people. So it's a Swiss man, 65 years old, married to a Thai national who has no income. They're on a retirement visa, live in Phuket more than 179 days. So they're a Thai tax resident. They've got one child, local health insurance, well-traveled and worked all over the world. That's how they've picked up all these different assets. So we'll go through the assets that they have that they remit into Thailand and talk through how each one will be taxed. This person also brings in more than 220,000 Thai baht of foreign source income. So that means they have to file a tax return even if they don't have a tax liability. They don't currently have a tax ID number. They've never filed before. So also that means within the tax year, they will have to get a Thai tax ID number from the local revenue office, or they'll have to engage with the company to get that for them. So what does this person want to do? They want to really calculate the personal allowances. They want to understand how their assets will be taxed and the credits and deductions they can have. They want to know if any transfers or remittances are not taxable, because not every single transfer to Thailand is taxable. There's a defined list of assets that are and aren't. So we'll go through a few now. And then also we'll mention about the TIN number. They need to get a tax ID number, which is quite easy to get from the local revenue office. A lot of people have engaged companies like ourselves to help get those as well if they don't know how to do this. So for this specific person, for someone who's 65 and they've got a spouse with no income, they've got a Thai local health insurance and a child, they get different allowances. So when you add all this up, they have 365,000 Thai baht of allowances. This is all on our website, the personal allowances and deductions. If we'll send across the link so you can look at everything on there. So for this case, this individual has 365,000 of personal allowance because of their situation. And then we go on to the assessable income. Anything over 365,000 Thai baht is taxable at their marginal income tax rate. So for the first 150,000, it's tax exempt. Then the next 150,000, it's 5%, and so on. I've actually put together a podcast to go through this specific, tax brackets. So if you'd like more information, feel free to ask and I can send that across. So for this example, this specific person, 365,000 of allowances. Because the first 150,000 Thai baht is tax exempt, it actually means they can bring in 515,000 Thai baht of taxable income before they start paying tax. This doesn't mean they don't need to file a tax return. If they bring in more than 220,000 of foreign source income, they have to file a tax return. So just because you have to file doesn't mean you have to pay tax. So what we'll do is then go through the next steps. So how did they get any credits and calculate what assets they've got. So next step, we've gone through, they've got 9 different assets that they're remitting to Thailand for this specific person. So these are just an example of the 9 things that this person, sources of income that they're bringing into Thailand this tax year. So they're bringing in cash in the bank from previous years, inheritance from a father's estate, US Social Security. He was a busy guy when he was working. He's got a UK private pension and UK state pension from when he worked there. He's also got an Australian rental property and he gets an income from that as well. He consults part-time for work overseas to an Israeli company for work conducted not in Thailand. He's got a Singapore investment account and he's sold a property in France. Now, the purpose of having these different assets is just so we can explain for different types of people to help more listeners to understand their own situation and how this might apply. So it's very easy, actually. It doesn't matter where you're from or what jurisdiction your assets are. If you follow these simple steps, you can easily calculate for your own situation. So the steps are, first of all, exclude any non-taxable remittances. So any assets that are not taxable in Thailand, first exclude those. We don't need to deal with those. That's not part of the personal income tax filing. Next, we work out what types of assets are being remitted, so we know how the taxation works for each one, because just remember, each asset class has different ways that it's taxed as personal income. Next, then we look at the relevant double taxation agreement for those assets to see if there are any exclusions. And then the next step is we calculate how much tax was paid, if there was any tax paid, and then we can potentially use that as a credit. So we go through these steps for every single asset that people have. So on that example, we can see at the top, the ones in green, so cash in the bank from previous tax years, inheritance from a father's estate, US Social Security, and all of these are not taxable assets in Thailand. So they're not taxable under the personal income tax rules. So we don't need to look at these in the calculations. Like Alina mentioned, we still need to mention the Social Security, but it's not taxable asset. Let's exclude the assets that we know are not taxable. So the top ones, so the cash in the bank from previous years, inheritance, Social Security, and the civil service pension. And then we can look at the other assets. So what we've done here is just note what kind of asset are they. So UK private and state pension are pension income. Any rental income is just rental property income. If you receive like a consultation fee, that's classed as income in Thailand. And Singapore investment, if you take a withdrawal, it's the investment capital gains that's taxable. And selling a property, like in France, then it's the property capital gains. So that's what the actual criteria for those assets is. Next, we need to look at the relevant DTA for any exclusions and special rules. So for this situation, it's only the ones that we mentioned earlier, US Social Security. There are no other exemptions or special notes for any of these assets. So what does that mean? In the DTA for all of these assets, they show may be taxable in the home country and in Thailand. So what it means is they can be deducted tax at source, and also if they are remitted to Thailand, they can be potentially taxed in Thailand as well. It depends if they're remitted into Thailand. So what are we going to do now is calculate what the tax is for each one, for each situation. So for a UK private pension and UK state pension, in the DTA, it is not noted in there. There are no special exclusions on there. So what does that mean? It means anything that's remitted to Thailand is added to the income tax. It's as assessable income in Thailand. Now you can deduct any tax paid in the UK as a credit, but this doesn't mean you don't have to file, and also it definitely doesn't mean you don't have a tax liability in Thailand. It doesn't mean tax paid already, because in the UK, for example, you get personal allowances as well. That doesn't count. They just look at your net and gross, how much tax you paid, and they will ask you, right, okay, how much did you receive? How much were you taxed? That's the amount you can deduct, not your allowances or anything like this. Australian rental property, very clear. So it's taxable, may be taxed in Australia. If you remit that into Thailand, that's classed as rental property income, and that is added to your assessable income. You can use the deductions for credits in Australia. Israel, consultation fee, so not employed, but actually like a consulting fee, like a non-contract consulting fee. That, if it's remitted into Thailand, is taxable income in Thailand. If it's likely that that's not taxed in Israel, if you're not employed and through Israel, but if it is and you are taxed, you can potentially use that as a credit. Singapore investment account. So if you've got a general investment account, it's the same rules if it's Isle of Man, Singapore, Hong Kong. It's all the same for countries like this. You calculate the capital gain for the remitted funds. So let's say you have 100,000 Singapore dollar investment. It goes up 20%, and you decide you want to encash the whole thing and move that into Thailand. So you've gained 20%. It's at 120,000 Singapore dollars, for example. You decide you want to encash, send to Thailand. Then the taxable assessable income is 20,000 Singapore dollars. It's the capital gain part from there. Now you can use any tax paid as a credit on the capital gains, but some jurisdictions like Hong Kong, Singapore, Isle of Man, they are quite tax favorable on capital gains. So it means there could be a substantial liability in Thailand for the tax for the capital gains. Property sale in France. So in the DTA, it shows may be taxed in France. So this means that, you know, it's taxable. The capital gains are taxed in France on the sale of the property. And then if you remit that property fund into Thailand, the Thai tax rules show that you are taxed on the capital gains of selling property. So you can potentially use any tax paid in France as a credit, but it means there could be tax on there. Depending on your tax rate in France, residency status, there's many different complications like Alina mentioned, but yeah, these are just the general principles. It's easy for people to apply to other DTAs and assets by going through this. So that's a case study on how the tax credits work. Now, it'd be really good to explain how do these tax credits work in reality. So what everyone needs to do is actually, Alina touched on this earlier, it's up to the taxpayer to prove that the tax has been paid. They need to show the tax certificate showing the tax paid in the other jurisdiction. So you need a tax certificate to show the tax has been paid. It's not enough just to say that the tax has been paid. It needs to be show some sort of tax credit form or document that needs to be submitted to on the tax return in Thailand. Now, this is new in Thailand in terms of how the rules have changed. Now, the revenue have provided a lot of information on how the rules will work, but for submitting the submitting method's not actually been confirmed yet. That will be done later in the year, I'm sure, about how we actually record that. So there's a bit of uncertainty on how we record it, but we definitely know it needs to be recorded. So on to DTA tips and advice. So now Expat Tax Time really think it's important that you keep good records. Whether you work with ourselves or you file yourself, it's really important that you track every transfer that you send to Thailand and try to keep accurate records. And if possible, separate out your overseas accounts and overseas different types of assets when they're remitted. That means it's easy to file or simpler to file, especially for things like pre-2024 funds, because these are not taxable assets in Thailand. So if you can keep those separate, it's easier to report and file. So these are just some simple practical tips to keep good records. So next steps really are to, if you would like specific information on any DTA and asset, feel free to fill out the survey form. Then we can actually go through your unique situation. That will drive the focus for our future videos and content. And so we can actually provide more value to people for what they specifically would like. If you've got any specific questions, there's quite a few in the Q&A now that I'll go through now. But feel free to send across by email or through the website. And also, if you'd like to sign up to the mailing list, we've got a weekly email update and podcast to keep you informed. So just remember, we're here to help. So reach out by email or website, either is fine. So on to the Q&A. So first question we've got, is I have a question regarding the use of may, as in may be taxed. Does this mean that if something is taxed in your home country, it won't be taxed in Thailand? Yeah. So this is pretty clear, Alina. I can answer, then you can add to this if that's all right. So if it says may, it means that that country has the right to tax it, but also it doesn't mean, it doesn't refer anything to your actual tax residency. So because it only says may, if you're a Thai tax resident, you also follow the local rules as well, so the domestic rules. Because it says may, this is an example of where, you know, for example, the French property example, it may be taxed in France. And then also, if you remit that into Thailand, it's taxable in Thailand and you can use that as a credit. Is that, Alina, is there anything to add to that?
Yeah, I would say that may, it's those cases when you can choose, it's may be taxed, but it's not obligatory will be taxed twice. When we're talking about when we're talking about property, it's all the time taxed in a place where it's located. So it's a main general international law rule. So the place of property is where the property will be taxed. But when I'm talking about may, it's same when we're talking about dividends, they should be paid. So they may be taxed in a country that is in the country of residence of the company that is paying your dividends, and same time it may not be taxed over there, depends on their local legislation. And same time it may be taxed in Thailand, but if you will provide all the details and confirmation that you have paid tax, that you have a tax credit in France or any other country, same time it may be taxed in Thailand or may not. So this is you may pay less tax by using double tax treaty, or if you are using it in not a proper way, if you are not following the advices of legal experts or tax experts, you will pay those tax twice. So this is the main point when we're using may, and especially when it's used in double tax treaties, you may be taxed.
Yeah, thanks for that. A good question, which is it depends answer. I'm in Thailand less than 179 days. Can I bring in 3 million Thai baht? Am I exempt from Thai tax? Now, this is a maybe because it depends what the money's from. Just because you're a non-Thai tax resident, if you're working for a company in Thailand or there's work conducted in Thailand while you're here, regardless if you're a tax resident or not, then there could be tax on the money that you remit, if that's what it's from. But if it's from foreign source income and you remit that to Thailand as a non-Thai tax resident, then there's no personal income tax liability in Thailand for a non-tax resident if they remit that in. Question, you said income needs to be declared in Thailand as well. Does that mean the amount remitted into Thailand has to be declared, or the total income received in the US? I think this was just maybe me miswording things. Thailand is a remittance tax basis for foreign source income. You don't need to declare your worldwide assets on your tax return. It's only for the foreign source income which is remitted into Thailand. So I hope that clears that up. One question about what's the mechanism for claiming exemptions and deductions? Is there a form? Is there a website? Well, no, it all depends on the individual jurisdiction and what they provide in terms of the tax certificate. Is that right, Alina? Maybe you're better to answer this. It's not a specific form that you can use. It depends where the asset is.
I may say that where you can get this certificate for the usage of double tax.
They're all different, right?
Yeah. When we're talking about this is a relationship between company that is paying dividends or interest or royalties to the individual. So basically company needs to receive this, first of all, tax certificate that the company is actually tax resident of those jurisdiction where the withholding tax was paid. And the other point, the individual, by declaring those tax in that country, should receive this certificate. That certificate is issued according to local legislation to use for the double tax treaty between the particular country and Thailand, Kingdom of Thailand, signed agreement, these blah, blah, blah. And then explanation of what's happened, like due to the payment of the dividends or something else. When we're talking about social security, and I've seen there was a question about social security payments in the United States, sometimes governmental authority, they're not putting tax on payments, on their payments. So they're presumed that you as individual who is receiving those tax should declare and pay tax in the end of the year. So you might receive this social payments every month or every 3 months, every half a year, or sometimes, as we're talking about pension, it's monthly payments. So you need, in the end of the year, you are submitting tax return and you are declaring that you have received this amount and you are paying this amount of tax. And by declaring, you can submit to the tax authority. So basically on a website of those or another tax authorities, you can find a submission to receive the tax declaration or tax certificate to use a double tax treaty. So it's not only just to use to get a tax certificate, it's a specific certificate, special document.
Yeah,
yeah, it has specific requirements. So you need to show and prove that you are tax resident in Thailand, that you have all the rights to use the certificate to be provided and shown in a tax authorities in Thailand. So it's a specific rule, and each country might have special requirements to get the certificate.
Yeah, okay, thanks for that. So we've got 3 questions in a row, which are all to do with, do I need to file or not? So I think it might be good just to clear up those rules. So I've had one question about the personal allowance of 120,000. Can I send that amount without declaring tax? We've had one question about tax returns. If I don't bring in money from overseas, do I need to declare? And then another question about sending in pre-2024 savings. Do I need to file? So if you do, so I'll just clarify what this actually means. As an individual person, non-married individual, the limit, the amount of income, accessible income, if it's over 120,000 Thai baht, then you need to file a tax return. If it's under this, then you don't need to file a tax return. That's the minimum requirement needed to file a tax return. If you remit in assets that are not taxable in Thailand, like inheritance, that's not a taxable asset, doesn't need to be filed in, or it's not a income tax assessable asset. It might follow the gift tax rules if you're over 10 million for an individual or 20 million to a family member, but not for personal income tax filing. So it's only, the only people that need to file a tax return are people who bring in over the limit for the minimum that needs to be filed. If you're not bringing in personal income, accessible income of over that, of under that, then you don't need to file. So I hope that kind of clears that up. Let me have a look at some of the questions. One question about the tax rate in the home country is significantly higher than Thailand. Do I need to pay more tax? Well, that depends on, again, on the asset that you're bringing in and how the DTA structures, whether that, whether that is actually taxable or not. Look at a few more. Do Thai tax residents need to pay taxes quarterly, or can we pay once per year? So yeah, good question. You need to file. It depends on what assets that you are remitting or what income you have. If you have property rental income or royalties, for example, then you need to file a half-year tax return as well. For the majority of asset types, you have to file once a year and then pay that once a year. So it's not quarterly. It depends on the asset. So it's a depends question. Question, what does cash in the bank actually mean? Does it roll over each year? Okay, yeah, so this is a good question. So what the definition is for pre-2024 assets, cash in the bank, means cash balances that are in the cash account, not an investment account, cash account, as of the 31st of December 2023. Not investment accounts or pensions, just cash in the bank. That amount, does it roll over every year? That amount is separate and that can be remitted to Thailand anytime. If you do add money into that bank account with potentially taxable income source, it becomes very messy for the tax return to state that you're bringing in pre-2024 assets and not new income. So I recommend you don't do that and keep it separate. Okay, one question. Where is the survey form? I think I put it on this chat. It's on the actual chat. Okay, any more questions? So if you are on the LTR visa, what does that mean? Okay, so it depends. That's a question about visa status and taxation on foreign source income. There is a visa called LTR visa. It has a royal decree. It's only been available for 2 years ago. 2 years ago, so September. Last September, it was a year before that. So the LTR visa, there's a wealthy pensioner visa and wealthy global citizen visa, which are tax exempt for foreign source income transfers. The criteria, this is a set criteria to meet those. If you do have any questions about that, feel free to get in touch. That's a good fix for some people if they have the assets and they meet the criteria for that specific, wealthy individual visa. Let's look at a few more questions. Okay, is it likely I'll have to obtain a tax certificate from the UK? Yes, we've answered that one. Still confused. If I bring in 1 million baht from savings, do I still need to file? Savings is you've got to really look at where's the source of the money from the savings and when was it put into the bank account. So money from the bank, whether that's in an overseas bank or WISE account, it doesn't matter what type of account. It matters what the source of the funds that's in that account is from. So you've got to really separate out within that account. If you bring in 1 million baht from savings, where's that savings from? Is it from pre-2024 or is it from pension income? Is it from rental property income? Where's the source of that money and from when? That's really important. Yeah, let's try and answer a few more questions. Okay, good question. So will foreign source income earned in 2024 while a tax resident remitted in 25 while temporarily not a Thai tax resident be taxable? Yeah, so if you are a Thai tax resident in the year of 2024 and you remit the money as a non-Thai tax resident in 2025, I don't know, Alina. So let's say someone's a tax resident this year, they earn foreign source income overseas, then they're a non-Thai tax resident next year, and they send the money to Thailand next year. Is that taxable in Thailand or not?
So basically, we need to understand where the money from and whether any tax were paid overseas. So whether anything was paid overseas. Another point that if you are non-tax resident of Thailand, but you still are sending money to Thailand and you are staying there and living there, but same time you will not be recognized as a tax resident of any other country. So in that case, you will have to pay tax in Thailand. You need to declare those money. Another point that I'm suggesting to the clients to all the time to declare their money. So if they're even in Thailand, they need to declare those money. In a case you will receive a tax certificate that you are tax resident in some other country and you are just sent money to Thailand, but money that were received in 2024 and you have all the confirmation that says from the source, from where they sourced, that they were tax paid and currently a tax resident of some another jurisdiction. In that case, you will not pay anything in Thailand, but you need to prove. So anyway, you need to declare everything. You need to, again, to submit all the information to show them the proof that you are not a tax resident of Thailand and that you have no obligations. Why it's important? Because in 2026 you will decide to be a tax resident of Thailand. And then they will consider those 2025 and they will see that the money were received in Thailand. And they will ask you why you didn't declare. So it's some sort of not obeying the rules, and they have all the rights not to accept your application to become a tax resident again.
Yeah, okay, yeah, thanks for that. So with the Common Reporting Standards and Thailand signing up to the Automatic Exchange of Information Act, and actually from September last year, Thailand receiving the first data feed from all of the other revenue departments, it means, you know, people should comply with the rules because, you know, the information is available if you're a Thai tax resident to the Thai tax authorities. One question here about bringing in cash into the country when you travel to Thailand. Should this be added to remittance? So it's a very important question, this. So in Thailand, there's a rule for customs. I think it's 20,000 US dollars that needs to be declared. That's got nothing to do with people's personal income tax reporting. That's just for customs at the airport or port. So if people bring cash across into Thailand and it's from foreign source income, so it's a taxable income and they're a Thai tax resident, then 100% it needs to be recorded on their tax return as remittance because it's a taxable income source. It doesn't really matter how the funds get to Thailand. Also, another point for this, which I get asked quite a bit, is if they send the money to a third party in Thailand or to a school or to a, you know, to pay for a car, it doesn't really matter who you send the money to. If you remit it to Thailand as a Thai tax resident, that's classed as remittance. So I hope that sort of clears that up. Yeah. So yeah, thanks for that. I think that's really good. Really appreciate Alina answering those questions. Thanks for joining. Thanks for listening, everyone, and feel free to reach out with any questions or queries. We are here to help. As you can see with Alina's answers, it's a complex area and it's not easy to deal with as an individual. You know, there is help available. We're here to help people like yourselves. So if you would like any more information, feel free to get in touch. And again, if you fill out the survey, we'll get back to you with the specific DTAs and the assets that are suitable for yourself. Okay, thank you very much.
Thank you to everyone.
Bye-bye.